Thank you very much for being here. So if you haven't noticed, our president is obsessed with tariffs. So that first question is, what is a tariff? So I'll ask the audience here and online. I guess you can't respond yet, but what is a tariff?
A tax on imported goods.
Tax on imported goods. So you are already well ahead of more than half the population. Only about 45% of people know apparently what a tariff is. You have other answers to that, but absolutely right. A tariff is a tax on foreign goods that are imported into the United States. So the question is this a good policy or not? Before we get into that, I will want to talk about the rationale for the tariffs that have been imposed and what we think about them. Here's the president on April 2nd of this year, Liberation Day, where he's saying we are liberating ourselves from the dependence on foreign goods, and we're going to have these reciprocal tariffs. And this is a big chart that he had in the what was the Rose Garden ceremony, outlining country by country what the tariffs are going to be on imported goods from those countries. You can see China 67%, European Union 39%, Vietnam 90%, and so on. If you go, well, so this is sort of the culmination, in some sense, of what he had long wanted to achieve. He had tweeted in his first term that I am a tariff man. He says, when people or countries come in to raid the great wealth of our nation, I want them to pay for the privilege of doing so. This is a way of maxing out our economic power. It'll make America rich again. But that's sort of his slogan, I am a tariff man. Here's some more quotes of things he said about tariffs. I'll tell you which one is my favorite. Greatest thing we've ever done as a country is to make our country rich again. Instead of taxing our citizens to enrich other countries, we'll tax and tariff foreign countries to enrich our citizens. Tariffs are the greatest thing ever invented. And then here's my personal favorite. To me, the most beautiful word in the dictionary is tariff. He later walked that back and said it's his fifth favorite word. He did recognize beautiful and other words as favorites, but tariff was very much high up there. Here's also a representative posting on social media. Tariffs are making our country strong and rich. That's what he sees. Tariffs are the central feature of this Make America Great agenda. So what are these tariffs? We've already correctly answered the question, what is a tariff? A tax on imported goods. And this is just comparing what the tariffs were at the beginning of the year, January, with where they are now. And so the blue bar is just indicating the country by country average tariff in January, and then the orange bar is the average tariff today. And as you can see, except for China, most of our tariffs in January, when the administration came in, were relatively low, about 3-4% or so on average, and they've gone up quite a bit. So if you look at that previous chart, what was announced in April, those were really very high rates, and the rates that have actually been imposed are a little bit less than that. But still, China, it's about almost 50% on average. European Union, Japan, Korea, about 20% or so. And then India and Brazil have been singled out for very high tariffs. The one on Switzerland was 39%, but was just recently cut down to 15%. And so there are deals being made to bring some of these tariffs down. So how unusual are tariffs of this height? Tariffs about 20% or more. Well, this is a picture of the average tariff imposed by the United States on all countries, on all imports, going back to 1790, when we have data for the first tariff. And it goes right up to 2024 or 2025. And as you can see, it bounces around a lot. In the pre-Civil War period, it's about 30% or so. In the post-Civil War, pre-World War II era, it's about 45% or so. That's the blue line. A lot of ups and downs. And then after World War II, you can see the average tariff collapses, goes down to a very low level. And in 1950, it was about 15%. That's slowly gone down from there. But you can see that, so bottom line here is that we've had an 80-year period of relatively low tariffs, taxes on imports. Historically, it's been a different story. I talk about a revenue period and a restriction period. Revenue being that revenue was very important for the federal government in the pre-Civil War period. This was the major tax, and it raised about 90% of the federal government's revenue in the pre-Civil War period. The restriction period between the Civil War and World War II, tariff wasn't designed so much to raise revenue as to restrict imports. keep imports out of the US market and keep the domestic market for our own producers. And then reciprocity, this is a period when we've reached trade agreements with other countries, such as NAFTA, such as the general agreement on tariffs and trade to reduce those tariffs and keep them low. So historically, we've had low tariffs except for this most recent period where these tariffs have gone up once again to a little less than 20% on average. But that's taking us back to, in terms of the orange line, back to where we were in the 1930s. So this has really been a big deal and a big shift in US trade policy, something we haven't seen for many decades. Now, I should mention, I'm an economist, and many people in the administration don't like economists and don't appreciate their insights if they have any on tariffs. So here's an interview in the Financial Times just a few weeks ago with Robert Lighthizer, who is the former US trade representative in the first administration of President Trump, saying economists have been wrong on everything. Here's J.D. Vance tweeting, it's almost like the economics profession doesn't fully understand tariffs. And he's reacting to a tweet saying that the producer price index that was released in July came in lower than most people expected. I'll come back and comment on this a little bit later, but one interesting point here is the date is very important, July 16th, 2025. And saying, well, producer prices haven't really gone up that much, and economists were predicting higher prices, maybe Vance is right that we got it wrong, except for one thing. The April tariffs were postponed for 90 days and didn't take effect until August. So the fact that the producer price index didn't go up in July, and that's reflected in the June number, isn't so surprising. But anyway, we'll come back to the price impact for a moment. So why is it that President Trump feels that we need, as a country, higher tariffs? There have been many rationales offered, and here are just four of them that we'll briefly consider. First of all, to raise fiscal revenue. We correctly noted that a tariff is a tax on imports. Taxes raise revenue. They bring in money to the federal government, so maybe this is a way of reducing the fiscal deficit. Number two, taxes on imports. So we're going to keep out imports. If we keep out imports and exports continue on their merry way, that's going to reduce the trade deficit. So maybe that's an objective that we should all share and want for the federal government. Number three, reshore manufacturing, production, create jobs. Well, that's that idea that if we restrict imports, we're not going to be importing foreign cars. We're not going to be importing foreign steel. We're not going to be importing foreign textiles. We'll produce them here in the United States, creating jobs, reinvesting in manufacturing, and that will not make America great once again, too. Number four, President Trump has often spoken about the bad trade deals of the past, how NAFTA was a terrible trade agreement, how the WTO and the European Union were designed to screw the US. So maybe we need these tariffs to strike a better bargain, to get a better deal, to achieve true reciprocity in trade. So these are the four principal reasons that the administration has outlined for why it wants higher tariffs. And what I'd like to do is sort of critically engage with each of these four arguments and talk about some other things as well. Okay, so what about tariffs as taxes, raising revenue? So this is from the monthly bulletin the U.S. Treasury Department puts out about the sources of income and the sources of expenditure in the federal by the federal government. I believe this is for the entire year, fiscal year 2025, which just ended. And you can see on the right-hand side there all the things we spend money on: Social Security, Medicare, net interest, which is growing. We now spend more on net interest than we do on defense, which is an interesting switch in how we're spending money. And on the left-hand side, we can see where the money is coming in. Individual income taxes, Social Security taxes are the two biggest components. So you might think, and then you can see this line here, the deficit of almost $2 trillion. Maybe we could make up some of that with customs revenue. Well, we've had the tariffs in effect for a few months now. And where do we see tariffs here? Well, they're right there, customs duties. It's pretty small. But the point is that there's not much scope for expanding this very much. We're not going to be able to close that deficit by levying taxes on imports. Why? How much revenue do we get with tariffs? It's the tax rate times the tax base. That determines how much revenue we get. Why is it we raise so much money with individual income taxes? Well, that's a big chunk of gross domestic product. That's a big chunk of the economy, personal income. How big are imports? Imports are about 14% of GDP. So that's a sort of a small tax base on which to levy these taxes. It's also a very elastic tax base. What happens If we take the tariff of 20% and double it, will we double the amount of revenue we get? Well, the problem is the tax base imports is going to shrink. So that revenue is going to be very elusive. If we all have to pay higher personal income taxes, well, we're all still probably going to work. So it's a relatively inelastic tax base, whereas imports are very elastic. If we tax them more, they're going to shrink and they won't give us the revenue that we expect. So this idea that we're going to use the tariff to somehow balance the budget, or even as President Trump has said, to issue big rebate checks to cut individual income taxes, the money is just not really there. Another point to be made about tariffs as a tax. It's what's known as a regressive tax. That is, it hits lower income households more than higher income households. So this is just a chart made by the Council of Economic Advisors in the previous administration, looking at the distribution of a 10% across the board tariff on different quintiles of the income distribution in the United States, and what the impact is on their family income. And what you can see on the far right is the top 1%, they're not going to be really affected by the tariff that much. So if we're talking about millionaires or billionaires, they spend a relatively small amount of their expenditures, or devote a relatively small share of their expenditures on traded goods. They're buying real estate or assets or land or things of that sort. Whereas lower income households are buying more clothing and shoes, things like that, which are going to be hit by these taxes, and their budget will take a harder hit. So I don't think it's the case that most economists think that we're going to raise a lot of revenue with the tariffs. It's a tax that's relatively regressive, that is hitting lower income households more. So to the extent that we cut income taxes to pay for the tariffs, we're substituting a regressive tax for a progressive tax that hits higher income households more. Okay, well, what about this whole idea of who's paying the tax? I was predicated on the idea that it's going to have this burden on households. Well, President Trump is saying a tariff is a tax on a foreign country. A lot of people say it's a tax on us. No, it's a tax that doesn't affect our country. So, and so that sort of seems to make sense in some sense. We're taxing imported goods, so it must be other countries that are trying to sell us goods here. They're paying the burden of that tax. Now, there's always been a little bit of a tricky question of tax incidence. So, for example, Hanover has a dog tax. Do dogs pay the tax? No. It's the owner of the dog that pays the tax. Oh, we're taxing corporations. Our corporations are this entity. Are we really taxing this entity? No, we're taxing the owners of the corporation, the shareholders. If we tax imports, are we taxing foreign countries that are selling their goods? No, the tax is levied on anyone who brings in the foreign goods. But even that doesn't answer the incidence question, who pays the tariff, because a lot of the importers don't have big margins. They pass those taxes on to final consumers. And so that's what we see in some of the evidence I'll present in a moment, that a lot of these taxes just get passed through to final consumers. They're not paid by foreign countries, they're paid by us. And once again, this is sort of denied by members of the administration. Here on, this is, I guess, Morning Joe, Secretary of Treasury Scott Bessent, being asked, do you think tariffs help or hurt prices for consumers? And he says, tariffs help consumers. Do you believe tariffs are a tax on consumers? No, I do not believe tariffs are a tax on consumers. Well, it's hard to know then who's paying the tax. I think, once again, they believe that these taxes are being shifted onto other countries. But once again, there's just not a lot of evidence for that. So we have evidence from the first Trump administration when taxes were imposed. And here's a chart just showing the consumer price index on overall goods versus those that are affected by the tariff. And what we see is these are domestic prices in the US, much higher for those on which tariffs are being imposed, and the blue line, which is tariffs on, goods not affected directly by the tariff. But we can see this today in terms of prices. So if you go to the grocery store, you see a lot of shrimp these days because it's a sort of a holiday item. If you look at the prices back in April versus the prices today, those prices have gone up quite a bit. We import a lot of shrimp from Vietnam, Cambodia, and other countries. Those are countries that have been hit with particularly high tariffs. What about another product? Aluminum. I don't know whether you bought any aluminum recently. Usually you don't go out to Home Depot and buy a bar of aluminum, but if you bought a new item that uses aluminum, those costs have gone up quite a bit. In fact, there were two big increases in the tariff on aluminum, and I wonder if you could pick them out. Well, yes, tariffs do affect prices because it's affecting what can get imported into the United States. Um, Interestingly, this argument that we Americans are not paying these taxes, if that was the case, why did the White House trumpet the fact that they were cutting tariffs on coffee, tea, cocoa, spices, bananas, oranges, tomatoes, beef, fertilizers, and saying that this is a sort of a price relief for American consumers? So you really can't have it both ways. You can't really say, oh, when we impose tariffs, there's not going to be a price impact, but when we cut tariffs, actually, it's going to reduce these prices. The reason why they reduce these prices is twofold. First of all, the United States does not produce bananas or coffee or tea. So there's no real gain to the United States in terms of jobs by having more domestic production in those industries because we don't produce them. And second of all, they did it because obviously affordability has become a big issue in the United States, and they want to do something to try to relieve the burden on consumers. So even though the president and the administration will say no impact on consumers don't pay the tax, their own actions belie that because they're cutting the tariffs on certain items because they think there will be a consumer price impact. Okay, so that's that first issue of revenue and who pays the tariff. Once again, I'll look forward to questions in a moment. We can get into that a lot more. Second issue, maybe we should use the tariff to reduce the trade deficit. The United States has a fairly large trade deficit. That is, we import more goods than we export. And the question is whether that's a problem. This is where things get a little bit technical. So I'll sort of skim over this very briefly and won't get into the details unless you want to press me during the Q&A. But in some sense, this seems to make sense. You know, we're importing this amount, we're exporting this amount. There's a big trade gap. There's two questions. One, is that a problem? And if it is, would tariffs be a remedy for it? Well, what do tariffs do? They reduce imports. So it might seem like you're going to squeeze that trade deficit, get rid of the trade deficit that way. A couple of problems. Tariffs also reduce exports. So if your imports go down, but your exports go down too, the gap between them may not get squeezed. Why? There may be an appreciation of the dollar as a result of those tariffs, higher input costs. So a lot of what we import as a country are intermediate goods that feed into the production of other goods that we export. So for example, Boeing is one of our major exports, exporting aircraft. Well, what goes into producing Boeing aircrafts? Well, I've already showed you aluminum, and aluminum prices have gone way up. Steel prices have gone way up. Rubber prices have gone way up. All those things that go into an aircraft, that raises costs, will squeeze out exports. Also, foreign retaliation. So that will reduce exports. So what's interesting about this most recent episode is there hasn't been nearly as much retaliation as many economists predicted, but one country has retaliated, China. They now no longer buying U.S. soybeans, although supposedly there's an agreement to do so. Ask American farmers if they've faced any problems as a result of foreign retaliation. The answer is yes, they've lost export markets. Exports of agricultural products have gone down. And that's one reason why the White House just yesterday or the day before announced a $12 billion package to bail out farmers who have been adversely affected by the lack of foreign markets. But for those of you that have an economics background, you might know that the capital inflows from abroad really drive the trade deficit, and the U.S. fiscal deficit is also a contributing factor. That is, we need to borrow from abroad in some sense to finance our fiscal deficit. So I think one thing that we could do, if we really thought the trade deficit was a problem, would be to reduce the U.S. fiscal deficit and therefore not merely need to rely on foreign capital inflows to finance that deficit. Regardless of the theory, regardless of that stuff, which I just sort of did very quickly, let's just look at the trade balance of goods. And if you're ever looking for good economic data, the place to go to is something known as FRED, put out by the Federal Reserve Bank of St. Louis, Federal Reserve Economic Data System. Everything's up there. It's very easy to get these charts. This is just the trade balance of goods, not including services, because the U.S. has a surplus in terms of export and services. And we can see, as you can see, the first term there, and this is the monthly trade balance, about $75 billion. And it doesn't really go down much during the first term, but it goes increasingly negative in the second term. And the one reason why the trade deficit increased dramatically starting in January is because businesses started anticipating that the Trump administration was going to impose higher tariffs. And so they said, if we're going to import now versus in 6 months, we better do it now before the tariffs take effect. And so the imports surged into the US. We can see we're past that period a bit because the tariffs are taking effect. But even there, the level of the trade deficit has not gone down. We're still back to where we were before. So that sort of roughly confirms what economists suspected, that there are other factors determining the trade deficit, and tariffs really aren't going to help out much there. That brings us to the third objective of the tariffs, which is to revitalize American manufacturing, get more people employed in manufacturing, increase manufacturing output. There's a little bit of a nostalgia work here, thinking that we have been deindustrialized as a country. We used to be a manufacturing superpower, and we're no longer doing that. And we've lost all these blue-collar jobs, and we should try to recapture that by producing things ourselves rather than importing them. And here's where the world has really changed over the past 50, 60 years or so. So if we look back at steel production in the 1970s, and we think about Bruce Springsteen or Billy Joel and some of the songs about Allentown or what have you, we think about this: hardworking men, just with a high school education, didn't need a college degree, employed a lot of people, working in the factories and the furnaces, pounding out manufactured goods. Well, that was true in the 1960s and 1970s, but the world is a very different place today. So we actually still produce a lot of steel. We produce about 3/4 of the steel we consume. And if you look at the level of steel production, it's basically the same as it's been in recent decades. But this is the way it's produced today. So what don't you see here? People. You don't see workers. Are there workers? Of course there are workers. But there's just one or two, not a whole bunch of them. And who are those workers? Well, they're PhDs from Carnegie Mellon or the University of Pittsburgh, or they have degrees in chemical engineering and metallurgy and what have you. And they're monitoring dials on equipment that's doing the production. They're not in there physically moving things around. So it might be possible to bring back some manufacturing production in the United States, but it's not going to bring back a lot of jobs that we had in the past, because all of manufacturing has become much more capital intensive. All of manufacturing has become much more technology intensive. And in particular, when we try to help out the steel industry, and that once again entails a raising of the price of steel goods in the United States, who does that hurt? Well, here's an example right here. Once again, I don't think you or me, we don't go down to Home Depot every week and say, I want to buy a bar of steel. We're not big steel consumers directly. But Caterpillar does buy steel. And they also export, because who do they export to? Where's the mining? Central America, South America, Australia, massive mines. They need this big equipment. There's a lot of steel here. And if you raise the price above the world market level, maybe to double the world market level, well, they're competing against Komatsu in Japan. And Komatsu doesn't have to pay double the price of steel, so they can offer a good product at a much lower price. That's where it hurts exports. How about John Deere? Do they buy a lot of steel? Yes, they do, and they manufacture in the United States. In fact, they project $500 million in tariff cost this year alone. So the question is, do they earn $500 million a year in profits they can just absorb? No, they're in a very competitive business. They don't have those margins. So what are they going to have to do? They're going to have to raise their prices because their input costs went up. And that means lower sales and fewer sales, both domestically and abroad. Here, a little closer to home, here's the Ford F-150, one of the most popular vehicles out there. Does this have a lot of steel and aluminum in it? Absolutely. Well, what's happened with Ford? They said the tariffs are going to cost them $1.5 billion. Is the auto industry so flush with such huge super margins they can absorb that themselves? Of course not. So they have to pass on those higher costs to consumers. That means fewer sales, and that hurts their competitive position. GM, even bigger, $5 billion hit in terms of their costs as a result of these tariffs. What's happening? Then there's downstream spillover effects. So this from the Minnesota Star Tribune. 600 Iron Range steel workers out of work as the auto industry cuts orders because of tariffs. So it's affecting the iron, yarn, steel industry and mining in the U.S. as well. So the point is that manufacturing is a very complicated structure. And it's very capital intensive, sort of the final goods stage. There are some workers in the earlier stages, but It's not as though you're revitalizing the whole sector by imposing these tariffs. We still export a lot of manufactured goods. You're raising costs. And you may help on certain industries, such as iron and steel, but you're going to hurt all the downstream industries that actually employ many, many more people than upstream. And that's why this from the Wall Street Journal just last week. What's been the response in U.S. manufacturing to these tariffs? 9 straight months of lower orders and a contraction in business. And what they say, they attribute this to increased cost of sourcing material. Tariffs, which have increased costs of sourcing material, continue to weigh on U.S. producers. So it's not as though these tariffs are really helping out manufacturing in a big way. So I'll just come back to this. Gee, maybe economists don't understand tariffs. Well, it could be that other people don't understand them too, in thinking that they're going to help out manufacturing. Just one other example of this, autos. Well, we've also imposed higher tariffs on autos. There's 25% across the board tariff on autos. What does that do to the price of autos that we're all going to face? New car prices were expected to increase about $4,000. And of course, that shifts demand to used cars. And so the price of those are going up as well. And so once again, you're not exactly helping out the industry by raising their prices, because that's not going to those firms. So when Ford and GM say, oh, we have to increase prices, President Trump once warned them not to raise prices. He's saying, in fact, he's done this with a number of other industries too, saying just because we impose these tariffs, don't blame us for the higher prices that you're charging. But then he's also said he couldn't care less if auto firms raise their prices. So once again, it could go sort of either way. Okay, so what's the trouble with tariffs? I didn't talk a lot, the couple last minute things I'll talk about, but here's sort of an economist standpoint. Here, this is from J.P. Morgan. So it's not an academic, someone who looks at it. This is what J.P. Morgan says. The trouble with tariffs, to be succinct, is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they're fine. And I think that's a view shared by many economists about whether we're going to get something out of this big tariff experiment that we're undertaking. So I want to talk about just 2 or 3 things to wrap up to get to your questions. First of all, what is this? It's the Supreme Court.
Yeah.
So there's a big case before the Supreme Court. They just had oral arguments in November. A lot of importers and domestic firms that have to pay these higher taxes sued the administration for imposing these tariffs. Not to get into all the technical details, but the president can only raise tariffs under certain provisions of U.S. trade law. And there are about half a dozen different provisions of law that can be invoked to raise tariffs under certain circumstances, because actually tariff powers are accorded to Congress under the U.S. Constitution. Article 1, Section 8 of the Constitution gives Congress the authority over tariffs. The president has done these things unilaterally without consulting Congress by invoking some of these statutes. The question is, which ones were invoked? The president invoked something known as IEEPA, the International Economic Emergency Act of 1977, which seems to give carte blanche to the president to do anything in an emergency, including sanctioning countries, sanctioning individuals such as Russian oligarchs and things of that sort. It does not use the word tariff. It's not clear that it includes tariffs in its purview. And so this court case, so there have been 2 previous lower court rulings against the administration saying all the tariffs that were imposed, most of them, are not justified, are illegal, or an improper use of the IEEPA statute. So 2 lower cases said, you got to get rid of those tariffs. Of course, the administration appealed to the Supreme Court. They just heard the case last month. So the big question is, when they decide, and we don't know exactly when they're going to decide, it could be in December sometime, it could be next spring, they could decide to wipe out all these tariffs. It'll be a very interesting decision. It seems like, if you to go by the questioning during the oral arguments, the court is very much against the idea that IEEPA justifies these tariffs. So the court could very much, with some likelihood, rule against the administration. If that happens, you might say, well, the tariffs go away. It's not so simple because, as I mentioned, there are about half a dozen statutes under which the president has authority to impose tariffs. And if you lose out one, you can probably impose a lot of these tariffs by invoking some other statute. The reason why the president chose this particular statute is because it's the most broad brush, most discretionary, least constrained way to impose tariffs, at least on its face. All the others, there's some details that the president would have to check before imposing the tariffs. But I think if the court case goes against the president will still try to impose a lot of tariffs just using some of these other statutes. The second thing I should mention is that, so anyway, stay tuned for this. It'll be very interesting to see what happens. The second thing I should point out is, what about all the trade deals? One of the motivations for imposing these tariffs was to get better deals from other countries. We have seen some fragments of details of agreements, but they're very skimpy. They're not legally enforceable. And it seems like the better deals are things that allow the president and his family to get business deals in other countries. So, for example, as I mentioned, Switzerland. The U.S. had imposed a 39% tariff on Switzerland. Now it's down to 15%. What happened? Did Switzerland open up its market in some big way? Did they change their policy? Well, Switzerland was already a pretty open market. They didn't impose many tariffs on U.S. goods, but what they did do is they gave the president a gold bar that he was very attracted to, which will be donated to the Presidential Museum, and he decided the Swiss are okay, so he cut the tariff. Same thing happened with Qatar and the aircraft that was gifted to him, and other countries too. They've sort of offered sort of a peace, a sign of peace, business deal or foreign investment in the U.S. Without really changing their trade policies in any significant way. So in other words, it's very much uncertain that these deals that are being reached will do anything to increase U.S. commerce. And I think that's it. So I've raised a lot of different issues, covered them very quickly, but I now await your questions and thank you very much for your attention. I'm very full now. So we go here in the audience first of all, and we'll go online. Yes.
How are we determining landed costs now? What's the procedure for that, to which then the import duty would be applied? Have we changed that at all?
Not really. So there's a bill of lading that comes in when cargo comes in. That lists the merchandise and the value of the merchandise, and then the tariff is just applied based on the value. So there have been some thoughts that firms may try to under-invoice. That is, if you're importing a lot of smartphones or something like that, you say, oh, it's $500. It's actually a $300 because then with a lower value, the tax burden on you will be lower. But we don't have evidence on that directly quite yet. Mm-hmm. But certainly what's going on is there's a lot of gaming going on with what country are you importing from, what do you call your product to try to reduce your tariff burden. And then the other thing I should mention too is that one reason why the price impacts haven't been quite as severe is a lot of exemptions have been granted. So we've granted China an exemption on certain electronic goods. So the price of your PC or your phone may not be affected by the tariff, just as now bananas and coffee are no longer affected by the tariff. So we imposed a lot of tariffs, but also there's an exemption process that you can petition the government to be exempt from those tariffs.
So I'm just curious, you have the J.D. Vance quote about economists not really understanding tariffs, but then you provide the evidence of the impact on manufacturing. You provide the evidence on prices and especially how it's regressively, a lot of these things are regressively imposed. I'm just curious, has the administration, what's the response to these facts? It's like, has there been a response by the administration?
Not so much, not directly. Sometimes they will say, give it time. So even the president at some point, I have a slide where he says there will be a little adjustment period. So they might say we're going through this adjustment period and the investment's coming in And it hasn't paid off quite yet in terms of output or employment, but there's a lot of factory construction, what have you. But we haven't quite seen that in terms of manufacturing output or whatever, or things of that sort. So I think they'd say it's coming, better days are ahead. You have to give this time, it's just been 6 months. It's got to work its way through the system.
And they haven't given a time frame.
No. Questions online?
Yes. Online, we have just a comment, great talk, thank you. But I had a question myself. What do you think the odds are that the consumers who are hit and are going to be hit hardest by the tariffs will have any idea that that's what's happening?
Most people won't, in the sense that you just go down to Home Depot, and if you're buying a rake or a wheelbarrow that's made out of steel or something, the price will be higher than otherwise. But you may not actually feel that directly, because a lot of the markup is not in terms of the raw product. So for example, a wheelbarrow, if it costs what, $200, it's a little high. $100 for a wheelbarrow. The cost to Home Depot might only be $50, and then the steel maybe 30% of that. So that price goes up. In other words, the price of the final goods not going up by 20 or 30%. It'll be muted, and you won't really see it. But if you order online, a lot of businesses now are tacking on a tariff charge, and actually, this is something the administration has been opposed to. They've been telling businesses, don't impose or don't reveal to the consumer the price is going up because of the tariff charge. But I know a lot of online businesses are doing that. So you'll see it and you'll be surprised when you get checkout. But that has been tacked on. There also have been stories in the press about people ordering online items from China and then finding that it's delivered with a bill for $800 or so. The extra tariff charges that were not included in what you had ordered online. So I think New York Times and others have had some articles on that. So it really depends. If it's a retail store in the U.S., you probably won't know or won't see or won't be, physically put on the bill. But if you're ordering online, you may actually see a little line that says that here are the tariff charges. Amazon wanted to do that, and Amazon was sort of told by the administration not to do that.
Well, we do have a question in Zoom now. Are there no economists among the Republicans in the Congress? If so, is there a way to get them to point out the truth to their colleagues?
I think a lot of the Republicans in Congress know what's going on in terms of their district. Certainly those from the farm states are very much aware about the adverse impact on the farmers of the foreign retaliation, the loss of foreign markets, and a lot of manufacturing states as well, from Michigan and other places producing automobiles. They know the huge disruptions to production in their states. But they're largely quiet, or they're not making public statements about this. But there is some evidence that they are pushing the administration quietly. So, for example, I know there's actually some of the private groups, the soybean farmers, have written public letters to the president asking for some sort of relief without criticizing the tariffs directly. So I think it's unavoidable that members of Congress know about this. They're not publicly broadcasting their opposition to tariffs, but quietly making their views clear, I think.
We have another online that says, what do you think are the best path or policies moving forward?
Well, as you might tell, I'm not a big fan of these tariffs, so I'd be happy if they went away. But that raises the question, then what should U.S. trade policy be moving forward? One country I haven't mentioned at all. Did anyone notice what country I didn't mention? I didn't mention many countries.
Canada?
Canada, I didn't talk about them directly. We had the U.S.-Canada Free Trade Agreement, which became NAFTA, which became USMCA. I think that's a fine agreement for North America, and there's nothing wrong with that. And to its credit, in some sense, the president had come in threatening and imposing higher tariffs on imports from Canada and Mexico, basically ripping up USMCA, which he had negotiated in his previous term. But that's largely not the case. Most of our imports from Canada now are coming in under USMCA rules, i.e. duty-free, and the same with Mexico. I should note of interest to the Upper Valley here. Many of you, if you rely on Irving for your propane or your oil, you might have gotten an email in February or March of this year saying, oh, if we actually go through with these tariffs on Canadian products, we're going to pass this bill on to you, even if you signed this contract for fixed prices. Once again, their margins are not so great that they can afford to absorb 20%. They would pass that right on to us as the final consumers, even if we had a contract with them. Once again, that didn't have to take effect because the Canadian tariffs were just imposed for a few days. But the country I didn't mention was China. And I think there is an issue about what our trade policy ought to be with China. So I think Mike Pence, for example, someone asked about Republicans, he's no longer in Congress, but I know he tweets a lot saying free trade with free nations. So if it's Canada, if it's Britain, if it's Germany, if it's Japan or Korea, these are democracies. These are market-oriented economies. We ought to have an open trade stance with them. In fact, we have free trade agreements with many such countries. China is a very different case. First of all, because of their economic policies, because of the geopolitical competition with China, it's not clear we should have open trade with China. But then you have to be strategic and you have to be thoughtful about what is it exactly will be our policy. What should we be imposing tariffs on? How can we reduce our strategic dependence on China for certain products, such as batteries or drones or what have you? Don't have time to discuss all those things, but I think that's a very different thing than what we're talking about when we talk about most other friendly nations that we get along with. So there's a case where the Trump administration and the Biden administration and the previous Trump administration and the previous Obama administration were much more thoughtful, much more wary about what our relationship should be with China. And so that's a case where I think tariffs may have much greater justification than many of the other instances.
How do you feel about non-monetary trade restrictions? Like, I led the international business at Hyperthorpe my time there, and we had to deal with the CE standard requirements in Europe to bring our product into Europe. And it wasn't a monetary thing, but it was an import restriction.
Yes.
Which we dealt with and solved and was fine. We had a big market share in Europe, but it was another thing to deal with.
In some sense, what's interesting about these tariffs is that there's sort of this 19th century or 20th century instrument. Most countries now, when they try to want to restrict imports or interfere with trade, through these non-tariff barriers and product standards and safety and sanitary conditions and things of that sort. These are things that can vary by product, can vary with time, and just require constant monitoring and negotiation between the U.S. and other countries. And so that's just going to be a part of trade policy going forward. If we set aside all the tariff issue, we're always going to have issues with standards differing across countries, and that's where either to harmonize them with trade agreements or having fora where you can negotiate some of the differences. Those are going to be very important for U.S. businesses. But once again, other countries have the same complaint about the U.S. We have our own standards that we set here, and sometimes that's a barrier to other countries selling here. So it's going to be part of an ongoing conversation. It's always going to be moving forward. Dealing with digital trade, the EU has very different policy than the U.S., which is very different from Korea and Japan. That's what countries negotiate about. Let's talk.
The non-tariff barriers do have some benefits. They make products safer, perhaps, and more appealing than in the other country that has the barrier. So, so there's a benefit.
Yeah, a lot of the regulations can be very reasonable, but they can also be captured by domestic interest groups.
Yeah.
So, for example, we can't sell our chicken in the European Union because of various sanitary and phytosanitary conditions of production here versus in Europe, and also GMOs. That's been an issue between the U.S. and the EU. Mm-hmm. And the question is Europe doing those things to help out the consumers and really provide for safe products, or is it doing to really exclude U.S. products? Mm-hmm. And so there have been disputes with the World Trade Organization where there's actually been rulings against the EU saying, actually, these products are perfectly safe. There's no scientific basis for your ban of certain GMOs or what have you. And yet, countries always have friction over these things.
Yeah.
Any other questions online? I'm not able to, I guess I could try to monitor the chat here, but.
That was all of them so far. I have one. You said this slate of tariffs might be overturned by the Supreme Court, but that there might be other avenues to, you know, put
Reinforce
tariffs in
tariffs.
place.
Yep.
Or something. Do you know why the Congress gave the presidency these powers to begin with?
Oh, yes.
They had it and then they kind of gave it away.
Yep. So one example would be to reach trade agreements with other countries. So it's very difficult for Congress to negotiate, say, a free trade agreement with Canada. So they authorize the president, you are authorized to reduce the U.S. tariff in the context of these agreements as long as you bring the agreements back. But more often it's authorization to increase tariffs without requiring congressional legislation. So one example is something known as Section 232, which deals with national security. So if there's an industry that's being threatened by imports and that will impair national security, the president is authorized after receiving a report from the Department of Commerce to impose higher tariffs. Another case would be if foreign countries are dumping products in the U.S. to the adverse effect on the domestic industry. Then the administration is authorized to impose anti-dumping duties to stop that. Or if other countries are subsidizing their exports to the U.S., there's a counter-subsidy legislation known as countervailing duties. Also, the president's authorized to increase tariffs against another country if they are found guilty of discriminating against U.S. commerce or unfairly burdening or restricting U.S. exports. So that was the authorization for the China tariffs in the first term, which the Biden administration did as well. The Biden administration increased tariffs and essentially banned U.S. imports of electric vehicles from China. How can the president just do that? Well, under Section 301, unfair trade, China's already been found, quote unquote, guilty of engaging in unfair trade practices, and that gives the president great latitude to increase tariffs against China on those products or grant exemptions. So it's just that a lot of these things have to do with foreign policy or certain areas, and Congress doesn't want, Congress is sort of slow in terms of getting legislation through, so they just sort of give this authorization to the president, but it's always legally circumscribed. It's only under certain cases. And what the president did here is imposing tariffs on every country in different rates. That's not really authorized under any existing legislation, except for this IEPA where things are a bit vague.
Are foreign exchange rates still playing a role in the whole thing? We had to deal with that often.
Oh, yes. Oh, exchange rates are a huge determinant. In fact, go to the New York Times today, there's an article about China's big export surge and the undervaluation of the renminbi.
Mm-hmm.
So unfair currency practices and undervaluing of currencies is a major issue.
Yeah.
Particularly with respect to China, with respect to some other countries as well.
Yeah, we had to deal with that a lot, the FX thing.
That's a really different bucket than trade policy per se. You could use tariffs as a threat to get countries to change their exchange rate policy, but the tariffs themselves won't necessarily change them directly.
Anita on Zoom notes, in the question of the quality of agricultural products coming from the US into Switzerland, where I live, the feeling of the consumers is that our Swiss standards should not be reduced in order to be able to buy US exports. And in several cases, like the way meat animals are raised, the feeling is strong against lowering the standards.
That gets exactly to the non-tariff barriers we were just talking about. They can have those high standards, but the question is, have they signed trade agreements where there has to be some adjudication process where countries negotiate? Or if you maintain those high standards, there's some other point I was just going to make about that. The question is that in accord with World Trade Organization rules that Switzerland has agreed to? And one way around that is labeling. So that person may want those high standards. Other people may want the cheaper goods. And one way around that is just to label the goods based on how they're produced or the conditions under which the animals were raised, and let people decide for themselves. So you don't need the government to come and necessarily have a one-size-fits-all policy for everyone, saying we're denying all these other imports. We'll just take the top, very specialty brands or what have you. But if you label things, people can decide for themselves. So that would be one. Because once again, if Switzerland says we want those high standards, well, the U.S. could say, okay, we're going to impose very high standards on the Swiss goods that we import too. And all of a sudden, Swiss exporters may find their market opportunities are being foreclosed in the U.S. So that's why it gets back to negotiations. You have to have sort of reasonable level on each side.
Okay, so BLUF,
Yes.
bottom line up front. Are you optimistic, pessimistic? Just personally, what do you think your opinion is of what's going to happen with all of these? I mean, we're not even a year into this administration with the crazy tariff policies. If you could look into the Doug Irwin crystal ball, what do you see? What's sort of the glimmers that you're observing?
So I and other observers have talked about peak tariffs. And I think we're past peak tariffs. That is when this past year, there have been a lot of threats and sometimes the imposition of very high tariffs. What we've seen also, I talk about this, the stock market reaction in the US, which is big declines in US asset prices. Even some trimmers in the bond markets, which I think really forced the administration to pause those April duties and postpone them a while. The rates of the tariffs are not nearly as high as they originally were talking about. And the number of exemptions keeps increasing. In other words, they say the coffee and the bananas, we'll take them off. China electronics, we'll take those off. And more firms, I think, are getting in the game of pressing the administration for exemptions from these tariffs. And I think if affordability is still a political issue, particularly as we're coming into next year in the midterms, there might be even more pressure for the administration to start reducing some of these tariffs. So I think, it's not clear they're certainly not going to go away, but they're going to be tempered to some degree. And I hope a year from now, we're just not talking about tariffs nearly as much as we have been now. But I will make this one observation, which I made many times in the past. Tariffs can go up quickly, but they come down slowly. So the president can just raise tariffs very quickly on certain products in certain countries. But as we saw with the Biden administration, which once again, the Biden administration was opposed to many things that Trump did on trade. Did the Biden administration get rid of any of the Trump tariffs? Almost none. Because once you imposed a tariff, first of all, there's revenue. Oh, that helps the fiscal situation. And then why are you going to cut taxes there and jeopardize that deficit reduction? Congress gets addicted to that revenue stream. Also, domestic firms, they'll adjust. So, Ford doesn't like the tariffs now, GM doesn't, but in a year or two, will they like them? Well, they're going to reorient their production domestically and reorient their supply chains. And then they don't want to adjust again. So more domestic firms might grow up under those tariffs, and then they're going to lobby Congress and the president say, no, don't get rid of those tariffs. Other countries will want high tariffs maintained on China. And so what happens with time is anytime you initially impose a tariff, it's a big shock, it's very disruptive, people are going to be opposed to it. But with time, adjustments are made, people get used to the revenue, get used to the new scenarios for production, and then they'll want the status quo. So there's always sort of the status quo bias. Once imposed, you don't want to change. And so I think there's a risk with time, these tariffs won't come down nearly as quickly as they went up. I'm going to show that one shot again. Whoops, right here. There's status quo bias there. When the tariffs are low, they tend to stay low. When the tariffs are high, they tend to stay high. There's very few transitions, but now we're moving to higher tariffs. They're not going to come right down. We'll stuck with them for some time.
And higher tariffs help reduce our exports.
Help. Yeah.
Or help.
Right.
Sure it's the right
yes, they do reduce our exports.
Yeah.
Any questions?
Are the words custom duties and tariffs still 100% synonyms?
Pretty much. Yeah.
Okay, yeah.
Any other questions online? Thank you very much.
Thank you very much.